Are central bank interest rates decisions so important for an economy, and what signals do you think this sends to the global markets?
Well, thank you for your question. The reason is all to do with cost of money. Cost of money is a very important aspect of economy. We have two costs that are very important. One is the energy cost, because energy cost directly relates to the inflation. And this has been proven even this year very much, where everyone said that the tariffs in the United States would cause the inflation to go much higher. But because the cost of energy has come down, the actual inflation in the United States has declined. So we could say almost 70 to 80% source of inflation is the cost of energy. So if the cost of energy is low, the inflation is low. The other one is the cost of money. So the second factor is the cost of money. And that falls with the central banks. When they advocate high interest rates, they are actually increasing the cost of money, and the cost of money makes the businesses more sluggish, makes the economy more sluggish, and also indirectly, it actually increases the inflation. So on one hand, they are saying we are increasing the cost of money, we are increasing the interest rate to reduce demand, but that is not very effective, because 80% of the source of inflation is the cost of energy. So, but the central banks want to say we have a much bigger role than they really have.
Okay, so how do changes in interest rates typically affect inflation and currency stability, in addition to trends when it comes to consumer spending?
Well, this is a very interesting topic you picked on. In previous to 1998, the target for inflation was a range between 1 to 4%. In 1998, 27 years ago, suddenly the central banks decided that the target should be 2%. And there was no science behind this, because why 2%? Why not 1.8%? Why not 2.2%? So they plucked this figure out of the air, and they said that will be our target for the inflation. And in order to achieve that, a number of times they have crashed the economy, they have reduced demand to achieve that. That has caused more damage to economy to achieving that target than the benefits for it. If you analyze the last 27 years, the cost and benefit of this 2% target, we will see why the European economies have declined, while the Chinese economy has actually it's gone up. So it's now, for example, in 2005, the Chinese economy was same as United Kingdom economy. Now it is 6 times, because they don't follow that rigid 2% inflation target. So I have to say, unfortunately, there is no logic right now to that 2% inflation target. It has become a religion. And once something becomes a religion, nobody challenges.
Well, sir, now you spoke a bit about like the idea of inflation and it being the main, there's no real science behind it. Now, China has cut interest rates to support growth amid the property market troubles and weak exports. Is this also based on science, and how effective can monetary easing really be in reviving the Chinese economy?
Well, again, going back to what you said, which is correct, they are trying to revive the property market, and they have reduced the inflation. But have they reduced it enough? Let's just look at the figures. Pre-2008 financial crash, the number of house transaction in United Kingdom was 1.8 million. 1.8 million houses were sold or changed hands in 2007. Today, for the last 17 years, the average has been 1 million. So, you look at it 17 years on, the housing market has not recovered. The number of transactions are something like 40% to 50, or 45% lower than what they were pre-financial crash 2008. So the question is, are banks, central banks, really serious about reviving the economy? I would say no. They are just career people. They sit behind a desk and they just make up figures. And most importantly, we saw that
Yes.
with the United States labor figures, the data they have is so out of date that all their forecasts and predictions are wrong.
So, sir, when it comes to like central banks deciding to raise or cut interest rates or even hold them, you're saying here that it's not necessarily based on the science. That it's just a career employee deciding to just do his job and not really care about what the economy is doing.
Exactly. First of all, the data they receive is usually 3 months behind the curve. So it's not immediate data. The other thing, it takes them a month to actually analyze the data. And by the time they explain the data and they're usually 4 to 6 months behind the curve. And that's what President Trump has been saying. They're always too late and too little. And it is amazing that after all these advances in technology, the data gathering for most central banks are so archaic, so out of date. And it again goes back to public sector. Public sectors, nobody cares. Nobody has come. I mean, it's very easy to come up with have online data, immediate data, or people who care. But you take in any country, the public sectors hardly care about what is happening. They just want to preserve their jobs.
Okay, so you think that there is no real trade-off when it comes to the decisions of the central banks when it comes to cutting, raising, or holding the interest rates? Does this directly affect the economy, or is it just moving along depending on the employee's decision?
Yes, and also let's look at the decision maker, like the Monetary Policy Committee, which is like 9 people. Mostly, hardly any of them are from business sector. They are most academics, so they sit behind the desks. None of them have run a business. They actually understand how to create a business from A to Z. So they just analyze data, and on that basis, they make decisions. Again, this is not what I'm saying. This is what President Trump has been saying. And so I think we need a real
better system.
Yeah, yes, exactly.
Well, sir, since you're talking about like the ideas of decisions when it comes to the central banks, now you said that in unison they decided around 98 that basically the inflation rate should be 2%. But today we see central banks moving in different directions, and they do things differently depending on the economy or the region they're in. Are we sort of entering a new era where central banks move in different directions instead of in unison or in sync?
Well, I hope so, because we've seen this 2% target is unrealistic. And also, maybe it was an experiment in 1998, which I accept. But when you see an experiment is not working, then you have to change. Just consider the number of things that have changed in the last 27 years. But this 2% target has not changed, because the intellectualism to challenge it is not there. Now, where the intellectualism, because who are the decision makers? Either politicians or the career people in the financial services in central banks. They are not there to challenge this. There's nothing in it. It's the private sector. But then the private sector does not have that much influence on central bank or on politicians. Otherwise, the first thing the private sector asks for is deregulations, because deregulation is a form of taxation, and every day the regulations are increasing, and they are making economies more sluggish, slower, and businesses are going out of business because of this, but then nobody cares.